Welcome back to Watch Your Assets, where we've got your money on our minds. I'm your host, Stephanie Bracken, and we are going to be talking about a very exciting topic today, which is qualified retirement accounts. Those two terms can be used interchangeably, but they're just what's considered qualified as opposed to non-qualified, or sometimes known as brokerage, taxable accounts, something like that. But what we're talking about today is qualified accounts. And whether you're looking to save for retirement, want to save on taxes, or are looking just for ways to grow your wealth, we're going to uncover why understanding qualified investments is crucial to your long-term financial plan. So everybody buckle up. This is going to be a really information, technical, heavy podcast. So what exactly are qualified accounts? Again, I said retirement accounts. I'm going to use those terms interchangeably throughout this. At the most basic level, these are investments that meet certain IRS qualifications and have certain tax advantages to them. The most common types are your IRAs, Roth IRAs, 401ks, 403bs. If you've served in the military or if you're a civilian that works for the federal government, you'll know a TSP. If you work for a state or local government, a 457 plan. There's a multitude of different types of qualified accounts, but I'm sure those are terms that most everybody has at least heard of. But do you completely understand your options and how they work? I don't know. We're going to find out. But if you don't, again, stay tuned. We're going to really get into some of the weeds with some of these things. But before we really dive into that, let's talk about why qualified assets can really be a vital part of your investment portfolio. Number one, they can be very tax efficient. They can provide tax deferred or tax free growth depending on the type of account, and I'm going to get into that. And that can obviously have a huge impact on your long-term financial plan. Taxes are one of those areas where people are very concerned about the amount of taxes that they're paying, of course, and we want to help people save on taxes where they can. So these investment vehicles can really be a place where we can either defer taxes for a little bit later down the line or completely avoid taxes. The biggest piece probably for a qualified account is saving for retirement. So that's going to be number two. These accounts are obviously designed to help you save for the future. And it can be easy to fall behind on retirement savings without a solid plan, without somebody who's holding you accountable. So we want to help you be that partner that helps you stay on track towards your goals and keep retirement, even if it's a long time from now. Retirement's going to happen to all of us, assumingly. I think that's kind of one of the biggest goals that people have, and it's one of the biggest life changes people are ever going to go through. So retirement, even again, if it's far, far away, it's still important to have some kind of plan and some investment goal that you want to start saving towards to help you get to a prosperous retirement. There's also some behavioral components of saving into, let's say, for example, a 401k. And again, I'm going to get into some of the characteristics of how these accounts function. But there's a behavioral component where when you dedicate a certain percentage of your paychecks to your employer's sponsored retirement plan, again, whether that is a 401k, 403b, all of those other types of accounts that I have mentioned, where you have told your employer, hey, with every paycheck, please put 8% into my 401k. There's a behavioral component where you kind of don't miss that money out of your paycheck. So it makes saving a little bit easier where you've almost put it completely out of your mind and it's just automatically happening with every paycheck. So that's a really cool piece of retirement accounts that you may not otherwise see if you are responsible for contributing into, let's say, an after-tax account or a cash account where you already have the money in your bank account. Being able to divvy that up towards savings can sometimes be a little daunting for people, and you may have expenses that come up. You may have things that you need to pay for more immediately where you may not have the funds in your bank account to be able to invest. So that employer retirement plan can be a really great tool to help you save pretty much automatically with every paycheck. For accounts, again, we're back to employer-sponsored retirement plans. There's obviously a lot of the times the employer contribution. Maybe not obviously. There's a lot of times where your employer will do a match on your accounts, typically maybe somewhere between 3 and 5% of your salary. So as long as you contribute up to that match, let's say it's 3%, if you put in 3%, you're getting typically an automatic 3% match. So you've gotten free money out of that. So that's a pretty cool thing too. And then there's also some estate planning benefits to qualified retirement accounts, where some of this money can pass, again, tax free if it's Roth, or tax deferred if it's traditional IRA money. But there can be some really powerful estate planning vehicles or estate planning techniques that can go on with your retirement accounts. And especially because you put beneficiaries on those types of accounts, they typically don't pass through probate, where if you only have a will in place and none of your other accounts have beneficiary designations on them. If you watched our episode with Jim Creenan, we talked about probate a little bit, where your estate has to go through the court system. And having beneficiary designations on your retirement accounts allows those to pass directly to the beneficiary and not ever go through probate. So that can be a cost savings as well. If you've set up your estate in a way that you can avoid probate, then you've saved yourself or your estate. You're passed away, so you maybe don't care, but your beneficiaries will care because they're the ones that are going to have to take your estate through probate. And really again, back to the retirement thing, really with qualified accounts, you're building a nest egg. And I mentioned this before, but you're helping your portfolio to grow, and you're setting money aside for the future. And in retirement, Social Security, we assume, is going to stick around. I know there's some, up in the air situations going on with legislation right now, but under the assumption that Social Security is still going to be around whenever you are ready to retire, Social Security may not provide a 100% replacement of your income that you were making before retirement. So retirement savings can help to bridge the gap between what you'll be able to collect from Social Security and what your living expenses are. So it can be a really cool thing to have happen, where instead of you receiving a paycheck from your employer, you're receiving distributions from a qualified account that still hit your income line. So they're still treated like earned income, but it's being structured in a different way. So let's talk about specifically the different types of retirement accounts. I'm going to start with the one that I think people know most often, and that's your 401k. Again, sometimes it's a 403b, depending on if you work in healthcare, if you're a teacher, if you work for a nonprofit, things like that. Those will be 403b accounts. Again, as I said, 457s come into play if you're working for a state or local government, if you're a law enforcement officer, if you're a firefighter, and then TSPs for those folks who are either in the military or, again, are civilians working for the federal government. But all of them have very similar characteristics in the way they're treated for taxes, their contribution limits, and then how they're treated for distributions down the line. So let's talk about contribution limits first. In 2025, your max 401k, 403b, again, synonymous terms, the max contribution limit is $23,500 if you are under 50 years old. If you are over 50, in addition to that $23,500, you can put in an extra $7,500. So that's a $31,000 worth of savings in total. If you have a simple IRA, that's another popular small business. Small businesses typically have can tend to have a simple plan, a simple IRA plan. Those contribution limits are a little different. For 2025, that contribution limit for you is $16,500. Roth IRAs and IRAs have slightly lower contribution limits. For, again, 2025, the contribution limits for both a Roth IRA and a traditional IRA are $7,000 if you're under 50, and then you can contribute an extra $1,000 for a total of $8,000 per year that you can put into these accounts. Now, historically, those contribution limits have been raised year over year, depending on the limits that the IRS has put into place. The 401k limits have gone up this year. The IRA and Roth IRA contribution limits have not gone up from 2024. But historically, we've seen them grow at roughly a $500 increment for those IRAs, Roth IRAs, and then the 401ks may be closer to $1,000. There's typically, in those types of accounts, penalties that come into play if you try to take money out of them before 59 and a half. 59 and a half is the kind of golden rule for any of your qualified retirement accounts. So before 59 and a half, now there are some exceptions to this rule, but in general, if you want to take money out of these accounts before 59 and a half, you're going to not only pay your normal income taxes, which is going to happen regardless of your age whenever you pull money out of your qualified accounts. You'll also pay a 10% penalty on the withdrawals. It's the early withdrawal penalty. Now, in 401ks, 403bs, anything that's, again, sponsored by your employer, they tend to allow for loans to be taken out against your retirement account. Now, you have to pay them back, of course, and you will pay them back with each one of your paychecks. So some of your contributions, instead of fully going into your investment buckets, or some of that money is going to be going back towards that loan payment. The amount of the loan that you can take out of your account is either it's the greater of $10,000 or 50% of your account value, with a maximum of $50,000 allowed per plan. So let's say your account balance is $40,000. The most loan amount that you can take out of that plan is $20,000. That's half of the account, more than $10,000. You'll also, on those loans, pay interest. So not only are you paying back the principal on your loan, like you would any other loan, your mortgage, car payments, anything like that, you're going to pay interest on that loan. And then if you still have a loan balance at retirement and you want to roll over that money into a traditional IRA or Roth IRA, you have to pay that back in a lump sum. And they will usually just deduct it right out of the balance of your account that you can roll over. So it's going to take away from what you're able to roll over at the end of the day. Now, I mentioned tax savings earlier. So how does that kind of play into this? So if you think about it, when you contribute into the pre-tax bucket of your 401k, that money is coming out before you've paid your normal taxes, your federal income, your state income, FICA taxes, Medicare, all of that stuff. So that money goes in pre-taxes, which is a really great way to save yourself in taxes today. If you contribute to the Roth portion of your 401k, you will have those contributions go into the account after taxes. So there's not as great of a tax savings now. However, because you paid the taxes up front on the money that you've put into your Roth bucket, the IRS is fine with that. So there's a caveat that happens whenever you reach age. It's 73 now. It's going to increase to 75, and it depends on when your birthday is. But let's just use 73 for an example because that's the current laws. At age 73, whenever you have any type of non-Roth retirement accounts, 401ks, IRAs, 403bs, any of those accounts that I keep mentioning, any of those accounts are going to be subject to what's called required minimum distributions. So required minimum distributions are the IRS's way of getting some tax revenue off of the funds that they have allowed you to grow tax deferred from the time you put in those contributions until you're 73. So at some point, to be a little bit cheeky, the IRS wants their money, right? They say pay up. So you're going to have to take out a percentage of your accounts each year from age 73 until your life expectancy. And that number is going to vary based on two factors. So it's based on your December 31st balance in the previous year. So let's say if you're turning 73, in the year you were 72, December 31st, they're going to use that account balance And then they're going to divide that by a factor that's part of the IRS's uniform life table. And it's a factor that's based on your age. So based on what they've deemed to be sort of normal life expectancy, there's a factor that is correlated to different ages. So they use those two factors to determine what your RMD is going to be. It's about somewhere between 3 and 4%, but that is not a hard and fast rule. And it's going to increase over time as you get closer to life expectancy and assumingly as your account continues to grow. But the typical case is that you're in a lower tax bracket than you were whenever you were working. So if you were making $200,000 a year before you retired, and now with Social Security, you're only making about 30, and maybe you have to take out a little bit for your living expenses from your IRA, which again will hit your income line. So let's say another 30,000 or so. That $60,000 is going to maybe put you in a lower tax bracket than you were in whenever you were making $200,000. So the RMDs, while they're fully taxable at ordinary income tax rates, they may not be quite as big of a tax hit as it was whenever you were just having your W-2 income come out. It's just a little bit more noticeable because that money isn't being withheld from your paycheck. You have to pay it at the end of the year. Or as you take distributions, we can withhold taxes for you. And I want to go back to contributions for a second. So typically with your employer-sponsored retirement plans, you have the ability to contribute into your pre-tax bucket or your Roth bucket, as I mentioned before. Not always, but a lot of the times you have the ability to contribute to that Roth bucket if you want to. Again, you'll pay taxes up front and you'll lose a little bit of money out of your paycheck because you've put that money in after taxes. But those accounts, if you have a large bucket of Roth money, Roth is not subject to RMDs because, again, you've already paid taxes on it. The IRS is cool with that, so they do not make you take RMDs. So Roth can be a really, really powerful vehicle, but it just depends on your situation. If you're nearing the top of an income tax bracket, perhaps the pre-tax bucket might get you a little more in tax savings now, and then you're okay with getting hit with those RMDs a little bit later down the line again because you'd be assumingly in a lower tax bracket. But sometimes for younger people, Roth can be a really, really powerful vehicle because you've got a long time horizon before you need to take this money out, and you will never have to pay RMDs. And once you have paid your taxes on that money when it goes in, you never have to pay taxes on Roth distributions ever again. So that's pretty cool. Now, Roth is still subject to the 59.5 rule, but the contributions that you have put in, especially if it's a Roth IRA, your contributions are never taxed and they're never penalized. So the only thing before 59.5 that will be taxed potentially is the growth on the accounts. But when you take a distribution from your Roth, again, before 59.5, assumingly you wouldn't do that, but if you needed to, the IRS would code your distribution as coming from your contributions first before it would tap into the growth. But the contributions on the employer match that is going to happen, typically 9 times out of 10, that's still probably going to go into the pre-tax bucket. So even if you are saving into the Roth bucket, you're still also building up the pre-tax bucket with your employer's contributions. So if you're putting in 8% of your salary into Roth and you're getting a 3% match, you've contributed, 11%, but 8 of it's gone into Roth, 3%'s gone of it into the pre-tax bucket. So you're still building up both of those. Now, again, that pre-tax bucket, you're still going to have to pay taxes on that whenever you take distributions out, but you're building both at the same time. So you're building a couple different tax buckets that are available for you after 59.5. Within your employer plans, you'll have a variety of different investment choices to pick from. And you'll want to make sure that you're invested in something. The last thing we want is for people to be putting a lot of money away and just having it sit in cash because you're losing money to inflation and you're missing out on market performance. So if you aren't directed to select investments whenever you first establish a 401k, that's something that you would want to make sure that you do because, again, we want you to participate in the market with every one of your contributions. So typically what happens whenever you put money into your 401ks with each paycheck, What happens whenever you select investments is what's called dollar cost averaging. What this means is with every paycheck, you're putting in little chunks. You're just putting in, again, 8%, 8%, 8%. And whenever you put that money into the account, you're contributing towards that 8%, 8%, 8%. You're investing that money just little by little. So you're taking advantage of incremental market growth over time. With a 401k specifically, you have a lot more freedom in the investment options that you have. Typically, you'll have a list of funds that you're allowed to choose from that can be stocks, bonds, mutual funds. There's something called target date funds, which kind of package up stocks, bonds, mutual funds. And depending on the date of the retirement that you set, let's say, for example, you have a target date fund for retirement 2065. That's going to be a way more aggressive fund than a retirement date of 2035. So they use the time horizon on a target date fund, and they kind of deem how aggressive that fund is going to be. So if you have a long time horizon, a target date fund, if you don't like to be in your account every month and kind of selecting different investments, a target date fund can be a very great option because you kind of just set it and forget it. You just put a little bit of money into it each paycheck, and it's just reallocated and rebalanced every so often. But the investment, let's say it's Vanguard, for example. So if Vanguard has a target date fund, 2065, let's just say, they are the ones that kind of allocate what's in that particular fund, but you don't have to select the investments. They are selecting the investments within that target date fund. You just hold the entire fund. And again, it's made up of a variety of different things that if it's that far out are pretty aggressive. If you choose a retirement date that's a little closer to today, it's going to be a little more conservative. But you are free to select from any of the investment choices that you have available to you in those plans. Now, you don't have the option to invest in anything you want to. So that's one of the limitations, is that you are kind of subject to whatever your employer has selected as the variety of investment choices. But typically, they're not so bad. And then for 403Bs specifically, you have a limit on what you are allowed to invest in within those accounts. So you can either invest in mutual funds or in annuities. So if you are a teacher, or again, you work for a public health plan, a nonprofit, a church, something like that, and you have a 403B, you're going to see your investment choices are going to be limited to either a mutual fund or an annuity. With IRAs, Roth or traditional, if you're having those accounts held at a private investment firm, let's just use YTS for an example, we have access to a lot more products and investment choices than you typically have within your 401k. However, you're subject to those contribution limits, which are lower in an IRA than they are in a 401k. So if you have the ability to put into your 401k and again, get some of those tax savings, or just put that money aside and you don't even miss it out of your paycheck, that can be more advantageous on that side because there's higher contribution limits than your IRA. But if you're able to max out your 401k, there's no reason why you can't also contribute to an IRA or a Roth IRA. If you do a Roth IRA and an IRA, you are limited to the aggregate contribution limit. So you can't put $7,000 in a traditional IRA and a $7,000 into a Roth IRA. It's the aggregate. With Roth IRAs, there's a bit of a caveat with who is allowed to contribute to a Roth, and it's subject to your modified adjusted gross income, or your MAGI. So if you are a single filer and you make less than $150,000, or if you're married filing jointly and you together make less than $236,000 a year, these are 2025 contribution limits or income limits, you are good to put the full amount into a Roth IRA, no limits on that except for the contribution limits that have been set by the IRS. Now, if you make if you're a single filer, between $150,000 and $160,000, you're going to be limited on how much you can put into the account. And there's a formula that goes into how much you're allowed to contribute, but you're only going to be allowed to put in a certain portion of that max contribution of the either $7,000 if you're under 50 or $8,000 if you're over 50. And then for married filing jointly, that range is from 236 until 246 for total household income. And again, that's a formula that is some limit, some guide rails that come into play whenever you're making between those numbers. If you make above 165 if you are single, or 246 if you are married, you cannot contribute to a Roth IRA at all. You can still contribute to the Roth bucket of your 401k, but you just can't put money into a Roth IRA. I think there's a misconception about Roth IRAs only being for the rich, and that proves that that's actually not true at all. Because if you make over that certain dollar amount, you can't put money into a Roth IRA directly. Now, there is something called a backdoor Roth contribution where you can put money into a traditional IRA, which a traditional IRA does not have those income limitations on it. You can make millions of dollars a year and still max out your traditional IRA. But what you can do then is typically, again, IRA money goes in before taxes. So whenever you do if you want to do a backdoor Roth contribution, you'll put the money into your traditional IRA and then schedule it as a conversion. So you can convert that money from traditional to Roth. You will pay the taxes on that money that goes into your Roth IRA, but now the money is in Roth. So that's the workaround, is that you just put the money right into an IRA, schedule your conversion, not contribution, you schedule your conversion. At that point, you'll pay taxes on that money. Boom, it's in Roth now, and you never have to pay taxes on it again. One other caveat to a Roth IRA is you have to have the account established for at least 5 years before you can take out even your contributions. So your contributions won't be taxed and they won't be penalized, but you're kind of locked in for at least 5 years before you can actually take that money. But once the 5 years has passed, then you're free to take your contributions out, even if you're under 59 and a half, and you won't be taxed and you won't be penalized. Let's keep in line with Roth conversions. So let's say you like the idea of a Roth, but you haven't put any money into a Roth. And now you're 55, thinking about retirement, and you have $500,000 in a traditional 401k where all of your contributions went in pre-tax, all of your employer's contributions went in pre-tax. When you retire, you can roll your funds from your 401k into an IRA. No tax consequences to doing that. But then what you can do is you can convert that money from traditional to Roth. There's no limits on how much can be converted each year. So you're allowed to convert as much as you can stomach to pay the taxes on, really. Typically with our clients, we like to take a measured approach. Again, we're working under the assumption that once you've retired, you will be in a lower tax bracket than you were before you retired. So let's say you were in the 24% tax bracket before you retired. Now, with just Social Security income, you're in the 12% tax bracket. So let's say because you have such a low tax threshold now, or tax limit, that you're in such a low tax bracket, let's say you want to convert to the floor of the 24% tax bracket. So we're bumping right up against the beginning of the 24% bracket, but we're not jumping into the 24% bracket. We can determine how much of your IRA can be converted each year to Roth to keep you below the 24% tax bracket. So we take a measured approach because we don't want people to convert that entire $500,000 balance in 1 year, because that tax bill is going to be absolutely gigantic. And we typically like to see people have a pretty decent amount of cash saved up, or again, non-qualified, non-retirement assets saved up to be able to pay for the taxes, the extra tax liability that's going to be associated with the conversion itself. So let's just say, for example, in any one particular year, we can convert $50,000 a year to keep you below the 24% tax bracket. I'm making up numbers here just to have round numbers. So every year, we're going to convert $50,000 per year from your IRA to your Roth. You're going to pay taxes on that money come tax day. But then you're going to have $50,000 in your Roth IRA. and now you have $450,000 in your traditional IRA. Now, you've lost some cash or, again, some non-retirement account money to pay for those extra taxes, but your Roth balance is some of the best money you can ever have because now that money is no longer subject to taxes ever. So that's a measured approach that we would take, and we would keep converting at $50,000 a year in this example until everything is converted, or until maybe we reach RMD age, or maybe you want to keep some in the traditional bucket. Maybe you're charitably inclined. There's something you can take advantage of called qualified charitable distributions from your regular traditional IRA, where starting at 70 and a half, you can take up to last year it was $100,000. The limit may have gone up a little bit, but per person, you can take out a certain dollar amount and send that money right from your IRA to a charity of your choosing. And that money, because it's a charitable contribution, never hits your income line. So that's another way, if you're charitably inclined and you want to save money on taxes, that's a really, really cool way to accomplish both of those things at the same time. So maybe with your Roth, you don't want to convert everything to Roth because you want to take advantage of some of those QCDs. That's perfectly fine. But we won't know what your numbers look like. We won't know what your situation looks like until we do a financial plan for you. The other thing to consider, as always, is living expenses. So if you have a lot of living expenses where we anticipate you needing to take large distributions from your retirement accounts to support your retirement lifestyle, Roth conversions may not make sense because you need that money to live on, where you may not have a lot of cash built up. You just might need that money to live on, and it just doesn't make sense. So it just depends on the situation, but that's something that we always want to review or at least consider whenever we're looking at people's retirement plans, because again, it's going to potentially save you taxes down the line because Roth IRAs won't be subject to, again, those RMDs. And then you're not passing on a tax burden to the next generation. So whoever your beneficiary is, when you inherit traditional or Roth IRAs, they get put into what's called a beneficiary IRA or a beneficiary Roth IRA. With the Secure Act, if you inherit an IRA or a Roth IRA after 2020, you have to take all of the money out of that account within 10 years of inheriting the account, whether or not you need the money. If you inherit a traditional IRA, you are going to have to pay income taxes on that money, same as you would whenever the person who passed away, whenever they were alive, they were going to have to pay income taxes on those distributions. You, as the beneficiary, will have to do the same. But Roth IRAs, Benny Roth IRAs, are not subject to RMDs ever. So again, whenever you have a regular Roth IRA, not subject to RMDs. As the beneficiary, you also are not subject to RMDs. You still have to take all of the money out of the account within 10 years, but now, theoretically, you could wait until the very last day of the end of the 10th year, take all of that money out of the Roth IRA and not pay 1 cent in taxes on that money. So Roth conversions really can come into play for legacy planning as well, because now you're not passing on a giant tax burden to your heirs. So let's talk about some of the other risks or shortfalls that come along with a qualified account. Obviously, with any investment account, anything that's invested in the market is always going to be subject to the fluctuations of the market. So same as your non-retirement accounts, same as, again, any account that's invested in the market is going to be subject to volatility. But the stock market kind of does this, where over time it's growing, but it's just that there might be volatility in between. So we typically say stay invested because the market, it tends to go down like an elevator, but come back up like an escalator. So it's going to come back slowly, but historically the market tends to rebound. So we typically recommend staying invested and staying in it for the long haul. And as I mentioned before, with the 59.5 rule, you have a little bit of a liquidity issue with your qualified retirement accounts. Now, again, you can take some loans out. Not one of the things we recommend unless you're really hurting. But just because you do have to obviously pay that back, and it's sort of eating into your future a little bit. Typically, don't love to see a loan, but I understand if that happens and you need the money. But because you will have penalties on early withdrawals, your money's not easily accessible in your 401k or a traditional IRA. And then there's also the issue or the potential for legislative changes. Tax laws are constantly changing, and we're seeing now with the new administration some serious changes going on to the government as a whole. And with that may come some changes to how things are structured, tax consequences of having these different types of accounts potentially, and the constant changing of IRS regulations and rules and contribution limits, all of that. So to close out, let's talk about how do we maximize benefits. I think the easiest thing to do, and might not be easy in practice, but contributing early and contributing often and consistently are going to be your best friend. So even if you have to start out by just putting in 3%, if you get a 3% match into your 401k, even if that's where you have to start there and then incrementally adjust your contributions so that with each paycheck, you can kind of get a feel for how putting different account or different percentages into your 401k is going to affect your paycheck. Because I don't want people to have a goal to put in 20% of their pay into their 401k, but then have to live on ramen noodles. So there's a balancing act. The numbers are one side of the equation, but then there's the human side too. So if you have to start in just little tiny chunks, that is better than not doing anything at all. And again, taking advantage of that employer match is going to be huge. So if you think you can only put in 1%, but you're going to get a 3% match, I would advise perhaps to see if you can do 3% just to get that match. It's free money. It just makes sense to put in whatever your employer is matching on, if not more. Again, diversifying your portfolio. This is going to be your qualified accounts are going to be a different tax categorization than something that's in just a brokerage account, a taxable account, whatever you want to call that, where you're just able to invest in individual stocks into one of those accounts where whenever you pull the money out, you won't pay income taxes, but you'll pay capital gains. In this, you're creating a separate tax categorization for yourself, that things are treated a little differently for taxes, where you're potentially saving a little bit now in an anticipation that you're going to need to pay yourself back in retirement. And stay informed. Stay informed about tax law changes or contribution limits so you know how or when to adjust your strategy. And if you aren't sure, you can always give us a call and we're happy to help. And if you found today's episode insightful, please give us a like, follow, share with your friends. It's Watch Your Assets on all social media platforms. I'm again your host, Stephanie Bracken, and we will see you on the next one. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA/SIPC.